Welcome everyone. This is our second webinar in our Maine Farmer Resource Network webinar series this spring. The Maine Farmer Resource Network is a coalition of Maine agriculture agencies and organizations working together to connect aspiring and beginning farmers to resources for farm business success. And we had originally put together this series of talks for the Maine Agricultural Trade Show. We do a lot there. And so some of our partners are University of Maine Cooperative Extension, which is where I work. I run the Maine New Farmers Project. And other cooperating organizations are the Maine Department of Agriculture, and others. So today we have a guest speaker. So from 1980 to 2016, Mike Sciabarrasi was an agricultural business management extension specialist at the University of New Hampshire, leading statewide and regional education programs in agricultural finance, farm business planning, estate and succession planning, and risk management. In retirement, Mike continues to support state and regional extension programs in farm business management. And he has done a lot of work cooperating with University of Maine Cooperative Extension and our programs working with new farmers. So we're happy to have you here, Mike, today.
Thank you.
But before you get started, I just want to launch a little poll. It's just 5 questions collecting demographics because we are grant funded. So we're funded by the USDA, and we have to report back to them on who shows up to our programs. So if you could just fill that out real quickly and then we'll get started. So today, Mike is going to talk about tax implications for farm transitions. And we're excited to hear what he has to say, and he is going to fill the hour. So if you have any questions while he's talking, if you could put them in the chat. And Mike, do you want me to interrupt you while you're speaking and ask a question, or do you want to just pause and see if there are questions?
I think there might be places that we can pause and see if there's any questions rather than try to take it as we go along, because there may be a lot of questions. If we don't get to your questions, I'm happy to respond to you via email or whoever else you would like. Phone call, and you can communicate that on to Chris.
Yes, that sounds good. And if you're listening to this after the fact online, do feel free to email us. I'll put our information down below. Okay, Mike, if you want to get started, that'd be great.
Okay. Let's try again. You see that or not?
I don't see anything yet.
Here we go again.
This is the joy of Zoom. Oh, yes, we see it now. Thank you so much.
Okay, so you have a copy of the outline that's going to be available to them. Is that correct, Chris?
That's correct. And I will be sending that by email to everyone that registered.
So you don't need to necessarily copy down the stuff that you see. If you just listen, all of this information will be in that outline. And so it's a lot of information. I've done a lot of estate planning type sessions over the years, and you get a feel for how long this information takes to present and how often folks have to hear it before they actually kind of starts to gel in their minds as to how it might apply to their operation. So think of this as an overview of some of the key concepts with regards to farm transfer and taxes, and some of the key tools. We're not going to be able to teach you everything you need to know or how it fits into your operation, but at least give you a start at what some of the options are and what questions you might ask your attorneys or other folks you deal with in developing your estate succession plans. Before I go into the presentation, you see this acknowledgement disclaimer. This is supported by AgFTAP, which is a program funded through USDA to improve tax education amongst farmers, particularly beginning and new farmers or smaller family farm operations. And we're required as part of this agreement to tell you that the opinions in this presentation, findings and conclusions, recommendations are mine and don't necessarily reflect those of the USDA. So you're so advised. So we're going to talk about farm transfer decisions. So why are we concerned about farm transfer decisions? Well, they play a lot of key roles, and oftentimes we look at it when we're dealing with estate planning and concerns about our heirs. We certainly think about it in our retirement plans. And if we have someone who's interested in taking over the business, it comes into play with succession planning as well. How do we do this, and what's the best way to get that farm into somebody else's hands so that I can retire nicely and the rest of my heirs can live happily ever after? I tried to break this presentation down into two principal concepts. One is common ways in which property is transferred, and then maybe some of the key tools that are used in facilitating property transfer. And I've got 3 key points I make on each of these sections. So keep them in mind, and we'll take a look at that. So when we look at transferring property ownership, the most common ways, if you think about it, is basically you can sell it, you can give property away, or you can hold on to it until you die and pass it in your estate. What method you use kind of depends a lot on your priorities, what you're trying to accomplish, what kind of timeline you have, and some of the tax estimates. So we'll be focusing a lot on the tax estimates in this presentation, but keep in mind, priorities are pretty important, right, with regards to heirs and owners and what you want to try to accomplish. Also, it's pretty important if you have successor to make sure all that stuff's built in and the successor has time to develop their skills so that they will be successful at operating that farm once you're no longer involved. So I recognize all those things, and this particular presentation just kind of focuses on the property. When we talk about property, we're talking about all of the farm assets, primarily most things except inventory, because inventory is an ordinary income item. We're talking about machinery, equipment, breeding livestock, land, buildings, that kind of stuff. So property transfer taxes, what kind of taxes do we have to deal with? Well, when you sell property, you open yourself up to a couple different types of taxes. Sales of property can trigger ordinary income tax on the gain associated with that sale, or it can trigger capital gains tax, or a combination of the two. And the rate that you pay for ordinary income and capital gains kind of depends upon how you file, whether you're filing single, married, jointly, head of household, and the tax bracket you fall in. And I'll give you a brief overview of that when we look at this stuff. With respect to the gift tax, most states have a transfer tax, but probably don't have a gift tax. And we really don't have a federal gift tax, but you might be responsible for gift taxes if you give gifts. And we'll get into that in a little bit when we talk about gifting. Now, estate tax, some states have an estate tax, but it's often a credit towards federal estate tax paid. I do know that Maine has an estate tax exclusion, and we'll talk a little bit more about that. So property passed in your estate to your heirs, you got a $6.8 million exclusion in 2024. New Hampshire has no estate tax and no inheritance tax. Some states outside of New England have inheritance tax, but I don't believe any state in the New England area has an inheritance tax. That's actually a tax paid by the people who inherit the property as opposed to the estate itself. Okay. So transfer method impacts property basis. And this is a very important concept. and you're going to hear this throughout the presentation. Basis is what you paid for the property. Pretty simply, it's your investment in the property for tax purposes. Usually we call the initial amount you pay in as the initial basis. I mean, you can have improvements to that initial basis and increase it so that the amount you have invested in a building, if you added a roof, now increases. And so you have a higher initial basis. It can also come down as a result of depreciation if a property is depreciable. So that initial basis in a tractor or in that roof gets depreciated over time. And what you have is referred to as an adjusted basis afterwards. So it's a little confusing because that term basis is sometimes thrown around in different ways. And the best way to think about it is what you have remaining on the books to recover at the time of sale for tax purposes. Okay, so initial basis is the amount depreciable assets can be expensed. For non-depreciable assets, it just sits in an account until you sell that asset, like land. And the basis that's adjusted at the time that you sell that property is what you use to determine if there's a gain on that sale of property. So here's another kind of interesting or important concept to remember when you're dealing with property, business property. It never goes on, the sale of business property never goes on your Schedule F as ordinary income. We're talking about the type of property that gets dumped on what's referred to as Form 4797, sales of business property. It's stuff that you use to produce the goods and services that you offer through the farm, but not produce on the farm for sale. And again, like I said, we're really principally talking about, equipment, machinery, breeding stock, planted trees, land, fencing, structures, improvements, that kind of stuff. Okay. So let's talk about what happens when you sell assets. There's different ways of selling assets, and I'll deal with them later. The three most common ones is just a direct sale, whether it's complete or piecemeal. The second one is a bargain sale, and the third one is sale development right, which is a sale of partial interest in the property. But what I want to first deal with is when we sell assets, what's the tax impact and how do you determine the rate of taxes that you're going to pay or the amount of your taxes you're going to pay on a piece of property with sales. So selling property for more than its basis, okay, remember that's the amount you have left in the books, plus selling expenses results in a gain. That gain is subject to income taxes. If the property is non-depreciable, like farmland, then all of the gains are going to be treated as capital gains. If that land's been held for at least a year in your business operation or wherever, then that gain is going to receive a long-term capital gains treatment, which is taxed at rates substantially lower than ordinary income. So you first got a capital gains associated with this, selling it for more than its basis plus the selling expenses. You recovered the basis and the selling expenses, none of that's taxable. But for the over amount, the gain that you had on that sale is taxable. It's going to be capital gains because it's non-depreciable property. And if you've held it for a period of time, it's going to get a really low preferential treatment in terms of tax rates. Now, with depreciable property, you have another little twist in all of this. Because all or part of that gain that you recapture is probably going to be a result of recovering depreciation that you've taken on that asset. And so recaptured depreciation is treated as ordinary income. So it's taxed at ordinary income rates. If you sell it more than its original investment original amount you paid for it, then you could have some capital gains. And again, if it's been held for a period of a year or more, that capital gains will get a preferential treatment. Okay, that's a lot already, right? The But I want you to understand that what we're looking at with these sales is we're trying to decide what portion of the sale is taxed as ordinary income, what portion of the sale gets this preferential treatment. And there's a reason why. Here are the ordinary income tax rates that you have associated with married filing jointly and single. And you can see that they go up relatively quickly, not as much as they used to in the past, but they range from 10 to 37%, right? And you're in the 24 and 30% range, somewhere around, if you're single, $100,000 of income, or $200,000 if you're married filing joint. So if you sold, I don't know, let's say a combine, and you originally bought the combine for $75,000, it's fully depreciated, and you sold it for $50,000. You're selling it for less than the amount you originally purchased. You're recapturing all of that as depreciation. If you're in the 24% tax bracket here, or say in the 22% tax bracket, then you're paying 22% on the taxes on that gain because it's recaptured as ordinary income. If, on the other hand, you sold land and you've held that land for a period of time, say you had a couple acres that were worth, I don't know, $200,000, and your original cost that you paid for those couple hundred acres was $25,000. So you have a $175,000 gain on that land. That land was held for more than a year. These rates won't apply. What comes into place are these rates, the capital gains, long-term capital gains rates. And you can see that these are considerably lower. The highest bracket is 20%. If you were in this bracket of 15%, now you'd be paying 15% on that $175,000, as opposed to what you might have been paying over here, 24 or 30% on that same amount of money. So knowing what your basis is, knowing whether the gain is characterized as ordinary gain or capital gain, has a big impact on what kind of tax situation you might be in and what kind of decision you might have with respect to taxes. All right, so let's go on from there to just the different methods of direct sale. Let's see. Yeah, so if you sell property for its full price, basically the seller pays all the taxes on any taxable gain at the time of sale. So gain equals sales price minus selling expenses minus the property's basis. The buyer's basis in the property now becomes the price paid. That's pretty important to know and understand, because if you're into the situation where you're buying a farm from someone else or selling it to someone else, that price that you have for the farm basically has to be allocated between the different assets that you purchased, okay? If you're buying the full price or the full farm. So some of that has to go to land, some of that has to go to buildings, some of that has to go to equipment. And what happens is that the stuff that goes to buildings and equipment gets recovered through depreciation, but the stuff that goes to land basically stays on the book as basis and isn't recovered until your sale. And this has to agree both between the buyer and the seller, just typically. So that's an important consideration with regards to direct sales. It's pretty hefty. It's going to be difficult for most buyers to cash flow this kind of situation, even though it's the most secure way of selling the property for the buyer. But on the same token, the buyer is probably going to have a sizable tax bill as a result as well. Sometimes what people do is they parcel out this a little bit over the years. So they're selling some of the farm this year, selling some of the farm next year, selling some of the farm assets the following year. And so what happens is when you do that, all your gains and whether they're ordinary or capital gains tend to be subjected to a lower tax bracket, because the more you have within a given year, the higher income you have, the higher tax bracket you're exposed to. If you can modify how much you have each year, and lower the amount as opposed to taking it all in 2024, but spread it over 2024, 2025, 2026, and so on through sales of particular assets, then you're only paying the taxes as you sell them. Okay. So it spreads that seller's tax burden over several years. It lets the buyer accumulate equity over a period of time without paying a whole lot of interest payments. The problem is sometimes they're not getting exactly the right assets they want or need to operate their business. The other issue we have with this is you've got to be careful. If you're going through some kind of piecemeal sale with an individual, make sure it doesn't look like a partnership arrangement. You know, your child or your neighbor or your best friend buying some of your assets, and at the same time you guys decide, well, we can do this together and house the cattle together, and we can harvest the corn together, and we can do that kind of stuff together. If you start doing that, what happens is now you have a partnership whether you want it or not, and there's a lot of risk associated with that. So with these kind of arrangements where you're buying the assets of a given farm over a period of time, be careful not to enter into an accidental partnership. And these kinds of arrangements really work well with equipment, machinery, breeding stock, but they can be problematic with land. How do you divide up the property? How do you account for appreciation land? If you share interest in land, in other words, if you give folks, your child or someone you're working with, a partial interest in your real estate, that partial interest in your real estate also means that real estate is now exposed to any debts or obligation that individual has outside of the farm. So you got to be careful with these kinds of things when you're dealing with real estate. It's better, and especially partial sales or interest in real estate. It's better, these kinds of piecemeal sales for types of equipments like assets like equipment, machinery, and breeding stock. All right, so I got a first example here. I got a real property example. Real property just means land in this case. You paid $1,500 per acre for land or $60,000 for a parcel in 1985. Today, property taxes say it's worth $200,000. So similar land has been selling for $100,000 or $10,000 per acre in your land, in your area. If you sold to land today, what amount would likely be subject to federal taxes? Any guess? You have, is it the $200,000 or the $400,000 that we're looking at as far as the amount that would be subject to federal taxes? So what we would do is we'd take the $400,000, which is the value of the 40 acres that I've sold it for. Assume I sold it for its market price. I'd subtract out the $60,000 that I have as a basis, and the difference would be $340,000, and it would likely be taxed as long-term capital gains as opposed to ordinary income. Now, what if I added a barn in there, and the barn was built in 1990 for $50,000, and today it's valued at $75,000, and I had a buyer for $75,000? More than likely, that barn's fully depreciated. That's the way assets go nowadays. They depreciate down to zero. There's no salvage value associated with them. So as far as the owner is concerned of that barn, that basis of the barn now is zero. All of the $50,000 have been taken as depreciation through the years. So when I'm selling for $75,000, what happens is $50,000 gets recaptured as ordinary income or ordinary income tax rates, and $25,000 gets a preferred capital gains tax rate. Okay. Bargain sales. This is when you sell property at a price below its fair market value. Okay, it's common among family members. If it gets too far below, IRS is likely going to consider the difference a gift. And there may be some implications with regards to that. in terms of what kind of basis the individual has, whether or not you have to file a gift tax return. So just be careful with those. So a seller will likely need to recognize the gift if it's a significant amount, and the buyer's basis will be lower than the fair market value. The only place this really works on bargain sales is if you have a business structure like a corporation or an LLC, and it's only owned by family members. It's closely held operation. And you want to sell shares of that business or an interest in that business to a child or some kind of close relative. Because it's a closely held business and really doesn't have, you know, a lot of market activity, IRS will allow you to discount the values of those shares or interests. But that's one of the situations where this does tend to work and is accepted by IRS, but you can't be greedy about it. So a 35% reduction in values is generally what we've seen is acceptable. Anything more than that, you might raise some eyebrows on the value of those shares or the values of those interests in that multi-owned family entity, either a corporation or an LLC or a partnership. The third type of sale we had up there was sale development rights. I don't know how much activity you see up in Maine nowadays, Chris, but there's still activity most places in New England. It doesn't seem to be as hot as a topic as it was maybe 20 years ago, but there's still some significant sales going on. So what you're selling is you're selling one of the privileges you have with respect to the property, and that is to develop it. You still get to keep the property, but you have to abide by the restrictions that they place on it. And you're still going to have to pay taxes on the sale because essentially you sold part of the property, if you will. And so you basically have to allocate the basis to the development rights value versus the overall value of the farm property. This is a good means of providing a seller with cash. And it makes the land more affordable to buyers. But remember, this is a one-time shot, right? Once you do this, it's no longer available for anybody else, theoretically, down the road. I mean, there's been challenges to these situations. I don't know how many of them are successful, but you're doing this a one time, and if that property is staying under that conservation easement by whatever organization is overseeing it. Okay, so that's sales. Are there any, let me see if there's any quick questions that might be relevant. Anybody have a quick question that might be relevant to sales of property? Okay.
There's nothing in the chat.
Okay, great. We still got everybody hanging in there, right?
Yeah.
All right, let's talk about passing assets at death. So basically the ownership is transferred to their heirs via at the time of death through their estate. When we take a look at an estate of an individual, it includes all the property that was owned and controlled by the decedent. The property is generally appraised at the fair market value at the time of death or 6 months later. If there's a reason for doing that, if the amount can be lessened, I guess, basically owned. But also keep in mind when we take a look at what's taxable is something less than the gross estate, because there's some charges that are allowed against the taxable estate. We'll get to that in a minute. But once you take a look at the taxable estate, you're not subject to any federal estate taxes until that exceeds $13,610,000 in 2024. So that means if you have two folks, a husband and wife, have interest in a farm, we're looking at $27,420,000 of farm value that can be passed to heirs without any federal estate tax due. Now, keep in mind, in Maine, you do have a taxable amount if it's over 6.8 million. So there's going to be some Maine tax that probably is going to have to be paid with respect to estate tax in 2024. Oops. So the taxable estate equals your gross estate minus any debts. Very few farms without any debts nowadays, although there are some doing quite well. So just keep that in mind. Taxable estate equals gross estate minus debts, minus funeral costs, minus administrative expenses, minus the marital deduction, the extent you want to pass on to your spouse, minus any charitable contributions. So there's still a ways to go to determine taxable estate after you first or initially establish the gross estate. Keep in mind, each person's estate is eligible for that lifetime estate exclusion amount, that $13,610,000 for federal tax purposes. And you have the ability between spouses for the spouse to take advantage, a surviving spouse, to transfer some of their exclusion to a deceased spouse's estate if it's done in a timely fashion. So if that becomes an issue and you don't want to wait for the second spouse's death, it can be pushed onto the other spouses, but it has to be done under certain restrictions. The nice thing about transferring property through the estate is the basis of the property passing to heirs via the deceased estate gets a stepped up basis to market value. What that means is that everything's being brought up to market value when it goes into the hands of your heirs, whether they're managing the farm or whether or not they're just inheriting property or assets from you in your estate. That's lovely because now we have all of that, that barn that we sold for $75,000, had to pay tax on. Now, instead of doing that sale, if we pass that bond to our estate, what happens? It bumps up to $75,000. And I can turn around and sell it tomorrow and have no taxes to pay for $75,000 if I'm an heir. Same thing with land. So that's a real big thing. That's one thing we never want Congress to take away from us, is that step up in basis. Now, there are some properties that don't get a step up in basis, but there are things like retirement accounts, and other kinds of income with respect to the person who died, those don't get a stepped up in basis. If you had an asset in an irrevocable trust, that does not get stepped up basis. If you had a life estate granted by another, it doesn't. And if an asset value actually is dropped in value, it doesn't get a stepped up in basis, it gets a step down in basis. But anyways, if that's the case. So everything's brought to market value with some few exceptions. Okay. Gifting, the third way of transferring. Sales, pass through the estate, and gifting. I want you to read that top line. I want you to have that in your memory forever with a gift. It's not only parting with the property, but you no longer have control of it. If you maintain any control over the property, you did not give a complete gift. So any conditional gifts are not considered gifts for tax purposes. So parting with property and control over it, receiving less than full consideration. The gifts are assessed at fair market value at the time they're given. You have right now an annual exclusion in 2024 of $18,000 per individual you can give without triggering any kind of tax implications. So you can give $18,000 to each of your children this year. You probably can give a little bit more next year to each of them, and not to have any impact with regards to gift taxes or anything else with regards to your estate. If you give a gift over the 18,000, sorry, to an individual, what happens is it reduces the amount you can pass in your estate tax, tax-free. Okay, so if I gave a $118,000 gift to my child, then my annual exclusion and my estate would be reduced by $100,000. Okay. There's no limits on gifts to spouses, to charity, for college tuition and medical expenses, and no taxes involved. Okay, so more on gifting. If you give property during your lifetime, the tax basis of the property gifted does not change. That means the recipient gets your tax basis. So let's go back to our barn. I decided I'm going to give my barn to my daughter, who's going to continue farming. Her basis in that property is 0 because I had fully depreciated that property. So when she turns around and sells it and does whatever else, all of it's going to be taxed. And all of it's going to be taxed either as ordinary income, at least initially, and then capital gains if it gets high enough. A gift tax return does need to be filed when a gift exceeds the annual exclusion amount of $18,000 per individual. Don't forget that. And individuals must keep track of their basis who receive the asset, but they don't pay anything. They don't pay any income tax, they don't pay any gift tax, and they don't pay any estate tax. That's all they do is basically inherit the recipient's tax liability. That's for the most part what happens. So think, when you think about this, I mean, when selling it, if you're buying the property, you get the basis equal to the price you paid. If you receive the property, what happens is the basis that you get now as the person receiving it is the same as the person giving it to you. So whatever's on their books becomes your basis. If it goes through your estate, well, it gets bumped up, and the person receiving the property as an heir now gets a brand new market value, which they can do anything they want with, depreciate, sell, whatever else they have options for. So there's a big variation in basis and some of the tax implications in the way you transfer property, whether it's by sale or through inheritance or gifting. There's a couple of things I want to just mention about benefits of gifting. Yeah, these basically donor transfers their obligations. It reduces your estate. It's not considered income to the recipient, which is great. A lot of recipients are really surprised at that if it's the first time that they received a significant gift. And it helps new farmers get started. Those are some of the key things we saw. Some of the problems is that, you give it away, it's no longer yours, you no longer have control. The problem is the recipient gets your basis. You need to recognize significant gifts and filing requirements. And it's probably a good idea too, if you're making significant gifts, is to have some kind of appraisal if it's not cash or stocks or anything that's readily easily valued in the marketplace. So if you're giving, cattle, or if you're giving equipment, you need something that says, maybe what I need to do is have my equipment dealer come by and at least give me a statement as to what they think the market values of those assets are. Or someone who's knowledgeable about cattle come by and say, let me get someone's opinion outside of my own as to what the market value is those are, so I can state that in my gift tax return. And there's a look back period for Medicaid. So if you end up giving away the farm and it's within a 5-year period, then what's going to happen is Medicaid is going to claw back some of that value of that farm given to whoever you gave it to pay for some of the Medicaid costs you might have had in a nursing home, for instance. So be careful of that. Okay, so let's go and revisit our property example, that 40 acres with a barn. Remember, we bought it for $60,000. Our fair market value of the land is $400,000. The barn was built for $50,000, and today's fair market value is $75,000. So if a widow parent gives their real estate to a child, what amount will be subjected to gift tax? Well, The fair market value of the real estate is $475,000. The basis is $60,000. So the value of the gift over and above the base, well, the value of the gift is $475,000. Are they going to pay any taxes? No, because what's going to happen is they're going to compare the $475,000 to $18,000, and the $457,000 will be the amount that's used to reduce their exclusion in their estate. So that happens first. So remember, everybody has that $13,610,000 exclusion in their estate. So if I give a gift over that amount of $18,000, the extent to which it's over $18,000 will reduce that exclusion. What will be the child's basis in the property? This is the problem. The child's basis in all of that property will only be $60,000. So if the child turns around and sells it in any period of time, they're going to have a substantial tax bill associated with that sale. Okay. How about if the child inherits the real estate after the death of the parent? What amount would be subject to federal tax? None. What would the child's basis in the property be? $475,000, the fair market value. Okay. Problems with gifts. Nice to get a gift, but remember what it means to the person that's receiving it. Okay. I'm going to bypass this one because I don't necessarily want to spend much time on that. I wanted to look at a couple of things on choices, but I think I'm going to leave that be. Move on to transferring property ownership. Any questions about sales, gifts, or inheritance that I can address quickly? No?
There was one in the chat about nonprofit, but I think you covered that.
Okay.
Yeah.
Transferring property ownership, tools for transferring property ownership. When we talk about the tools, now we're not necessarily talking about whether we're selling it necessarily or gifting it or passing it in an estate. We're talking about what actually puts the property itself into the hands of somebody else. So a lot of property is transferred by joint tenancy ownership, right? You own real estate as joint tenants. Under joint tenants, what happens is that when someone passes away, one of the tenants passes away, the property goes to the survivors, right? That's generally what happens. There is an option to do tenants in common. It's not a common way in which deeds are written in New England, but it is available in most states. And that allows you, if you own property as tenants in common, for the tenant to designate who their property will get, and it doesn't necessarily have to be the co-owner in that property, okay? It's important to remember with things like joint tenancy and some of these other things like transfer on death and benefit designee and payable at death, all of these things kind of trump what you have associated with a will or other things. They're kind of like higher level orders of distribution of assets to heirs. So you could be in joint tenancy with your spouse and decide that you're going to give your interest in the real estate to your kids, but guess what? If you're in joint tenancy, it goes to your spouse. Okay? The will would be disregarded. Okay. Let's see. Transfer on death, death benefit designee, payable on death. Those are usually associated with things like insurance or pension accounts or money market accounts or bank accounts. Those are the kind of things we generally deal with when we talk about transfer on death, death benefit, debt payable on death, beneficiary. The one in there that I haven't talked about yet in that top list is wills. These are kind of probably the more common ways of transferring properties. And wills are useful because, I mean, they can do a lot of things. You can use them to tell the state how your property should be distributed, and we'll talk about that in a few minutes. You can also use it to designate, if you have minor children, someone who manage the property or be a guardian for your minor children. And you can also tell the executor how to handle your estate and identify the executor. But I mean, a will is a fairly common tool that I think most people are familiar with. You just need to be aware if you're doing a will, what are the requirements for your individual estate in order for the will to be effective, in order for it to be recognized by the probate court, because it will go through a probate court with an executor, and the court will oversee whether or not that will is being carried out properly. The other tools that I want to talk about briefly are installment sale trusts and business entities, because these are probably a little bit more complicated than the ones up above, and probably deserve a little bit more attention. So an installment sale is when a seller finances the buyer's purchase. So the buyer makes a down payment, and then they make periodic payments of principal interest over several years. And the buyer basically enters into some kind of contract or mortgage agreement with the seller, okay? The terms can be favorable under installment sales, but they can't be interest-free. What happens with an installment sale is it's kind of convenient for the buyer, because now you're essentially acting as a bank, and you're giving them the opportunity to pay it over however many of years you might want to be able to, they might be able to afford it under. But you run into a problem as a seller, because with installment sales, if there's any significant assets that have been depreciated that involve the installment sale, it basically negates the privilege of spreading that payment over prior years, because regardless of how you receive the payments, anything that's recaptured as depreciation relative to the price you sold them the property for will be taxed in the year of sale. So the only thing that gets distributed in terms of the sales price is the amount that's subject to capital gains over and above depreciation. So this has become less of a useful tool for many farms, but it's still a tool, because it's a good way sometimes of thinking about a land transfer, because land transfers, for the most part, you're only going to have long-term capital gains. But if you're looking at a plot, a couple acres of land with all the buildings on it, it's probably not a good deal, because it's not going to spread that sales price over several years, because it's going to say whatever you recaptured as depreciation as represented by that sales price is going to be due in taxes the first year, regardless of how much you receive later through the installment sale. Yeah, I don't know. I know it's a roundabout. We used to use these a lot prior to the mid-'80s. But because of the issues associated with depreciation recapture, they become less and less useful, but they do have a place when you're taking a look at land. I guess that's my conclusions. So there's a couple other requirements on these things. You can only do installment sales on real, not personal property, but not inventory, because that's ordinary income. You have to meet 4 requirements in order to have an installment sale. You can't be a dealer. There has to be a gain, a capital gain. The deferred gain can't be only ordinary income, as I already talked about that, because all of it gets recaptured in the first year as a result of the installment sale. And at least one payment must be deferred for more than 1 year. So it has to go over multiple years, and it has to be some capital gains associated with it. These can't be interest-free, although a lot of people try to do that initially. The IRS will instate interest The interest that's paid you as part of the installment that you receive as a seller as part of the installment sale is taxed as ordinary income. And what will end up happening is that you'll have an interest accrued in there and the amount paid and all the other kind of stuff. IRS says the minimum rates basically have to follow the applicable federal rates. And you can look those up under IRS applicable federal rates for the month or two prior to the time that you enter into that sale. The applicable federal rates I looked at this morning are somewhere around 4 or 5% over the last several months. So they're not low, but they're pretty low. You have to recapture depreciation on the sale. And one of the other issues we have sometimes with installment sales is you do risk the buyer defaulting on payments. A nice thing about these, there's a couple of nice things about these, and I don't want to badmouth them completely because I think they do have a place sometimes, and I've seen them where they've worked well with some families. Is that you can set up an installment sale of some real estate, and then look at what the gain was, and basically what you're doing is you're spreading that taxable gain over the period of the installment note, however many years you've set it out for. And in any given year or any given month, you can actually decide to forgive a payment if the person, your child or whoever's running the business, can't make the payment for one reason or another. You can actually forgive the payment as a gift and recognize the gift if you need to. So it gives you a little bit of flexibility there. It also helps to fix the price of the asset if you ever go into a nursing home and that kind of thing. So if you've sold the land to your children and you end up going into a nursing home, you might have some argument for saying, well, that land's already been sold and we've set the price. And the only thing the children will be responsible for now is the price or the payment that's remaining on that installment sale. So there's a couple little things to kind of keep in mind when you're looking at installment sales. I'm going to show you this again. We put an installment sale. We had a selling price of $470,000. We know that our adjusted basis is $60,000, the amount we spent for the land. We recaptured $50,000 in depreciation in the first year. If you look here, you add that to the basis. We take that total away from this 475, and then what happens is the 375 is gross profit on this installment sale. Instead of paying taxes on 375 all in the year of the sale, that basically gets spread out over the term of the installment sale. So when you receive payments, 76.8% of that payment is going to be taxable in the year that you receive it. So you don't get taxed on this $365,000 all in the year of sale. That's basically what you're spreading out over the term of the installment agreement. Okay. Trusts. This is a big category. There's a lot of information associated with trusts out there. I'm just going to tell you some real basic information. Parties to the trust, the grantor, trustee, and beneficiary. The grantor is the person who sets up the trust. The control a grantor has in a trust will depend upon how the trust is structured and what type of trust. The beneficiary is the person who will receive the property in the trust or benefit from income from the trust. The trustee is the person in charge or persons in charge of following directions of the trust. And that can be an individual or business. So those are some important things to remember. The trust instrument details terms of how property is to be managed, how income is to be distributed, and the direction and conditions for distributing of trust assets. Two major divisions of trusts are irrevocable trusts and revocable trusts. And we'll talk about those in a moment. You want you to keep in mind that when you form a trust, if you don't fund it, it never becomes effective. And funding it means you actually put the assets in it that are going to be managed. So you need to make sure you put the assets in it that are going to be managed and fund the trust and kind of activate it. So let's take a look at the two principal breakouts of trust. Irrevocable trust. Generally, the grantor is not going to be a trustee, although in some situations they can be. Generally, they don't retain any rights to income or benefits from the property of the trust, although in some situations they can. Assets funded to the trust cannot be removed by the grantor in an irrevocable trust. Transferring assets to an irrevocable trust are essentially a gift to the beneficiaries and may be subject to gift tax. That's important to keep in mind. And the trust assets are not included in the grantor's estate. So basically they've given away, put the money in this trust and recognize that gift. And their money's being managed according to the trust agreement and supervised by the trustee. And sometimes the grantor has a hand in that.
Hey, Mike, you have about 3 minutes.
Okay, so revocable is the kind we see more people doing. The grantor is usually the trustee. Property in an irrevocable living trust continues to be the property of the grantor. Okay, it's important to have the assets titled in the trust name. Trust names beneficiaries to receive property at the death of the grantor. Trust assets are including grantor's gross estate, but not required to go through probate, and identifies a successive trustee. Will or trust? Well, the things you've got to consider: legal fees, probate court, privacy, whether or not, if you go through a will, basically you have to end up going through probate court and having the probate court oversee what happens with the executor and your assets. With the trust, that doesn't happen. Concerns about heirs and farm transition plan. Generally, a trust is more useful because a trust can be a living trust. A revocable living trust can be used to help with that transition plan. Okay. Business entities. That's the third one that we use to facilitate succession planning. The most popular one is an LLC. You can use corporations or partnerships. The key document is the operating agreement of that entity. Who are the owners? Who can be owners? Who has voting rights? Who has control? Who can acquire departing owner's interest? If you have an operating agreement, make sure you address these key issues, okay? Because that's going to impact how that ownership goes between individuals involved. What we generally do when we use ownership, when we use entities, is we separate out an operating entity from the real estate. I'm going to show you what it looks like. We have a parent business. We have a real estate where that property has been formed, that business has been formed, and you have an operating entity which runs the farm. Basically, this operating entity does the farming business, has the expenses and collects the income. This entity rents the real estate, whether it's fruit trees, bushes, buildings, and land, from whoever owns that real estate, which is oftentimes parents in a multi-family situation. Okay. Resources. These are in the handout outline. I want to give you some primary websites that I think you should look at, but I want you not to forget about the state extension and revenue agency websites in New England and in your own state. Often have a lot of useful information. If you're going to go outside the region, the ones I would recommend you looking at are the ones at the University of Minnesota, Iowa State University in Ohio. They seem to have a lot of good data and good resources with respect to succession planning, estate planning, and retirement. Thank you. And I have a half a minute. Was that
great?
So that's a lot of information, folks. I didn't mean to kind of blow you out of the water, but I wanted to just kind of give you an idea of the scope of some of your choices and what options you might have.
Yes, and again, Mike is available through email. So I will send out a follow-up email, and he will be included on there. So you can send any questions either to me or to him, and we'll get them answered for you.
Thank you so much for coming, and thanks for speaking today, Mike. We really appreciate it. You do a great job
Thanks.
explaining all these really complicated
Yeah,
things.
and don't be discouraged. It's the kind of thing you have to hear several times by several different people, and eventually the stuff starts to click. Unless you're one of those brilliant people who can absorb it all at once. But we haven't found. I'm not one of those, and I found many people that aren't like that. And oftentimes I see farmers several times at different meetings and events, trying to address the same topic.
Great, yes. And we also have an evaluation that you can fill out. If you want to click on that, I put it in the chat. I also, if you're listening online, I will put that right in the description of the webinar, so you can also give us your input. So again, thanks so much for participating. And we do have 2 more webinars in this series, so I will put that in the follow-up email as well. Great. Thank you, everyone.
Have a good day, all. Thank you, Chris.